So Ramesh is joining us today. We're going to be talking about alternatives in the portfolio. Can you tell us a bit about what Nine Point Partners are doing and what's your focus?
Thanks, Darius. Yeah, Nine Point Partners is a Toronto-based asset management firm. We've been we kind of actually had a management buyout out of Sprott Asset Management in 2017. So just not for 3 years, managing assets and contracts over $8 billion, based in Toronto, like I said. And our focus is really on alternatives because one of the things that you mentioned in the intro, Darius, was a focus on alternatives, and our view is that alternative investing, I think, has become a mainstream investment opportunity through pension funds like CPP, OMERS, teachers, etc., but hasn't really came into the retail forefront for about 10 years ago. When Nine Point actually was the pioneer in bringing in, one of the funds to the marketplace. So I think the alternatives are becoming in my view, actually, I think the word alternative will probably go away in the next few years because it becomes so mainstream, and you're kind of putting that 60-40, which is a dead in water portfolio theory away because 60-40 doesn't work anymore. It might have worked 10, 15 years ago when markets were simple, but today, it's a different world.
So this is a very good point you're bringing. I mean, there is an issue for anybody that's retiring, and we have over 1,000 Canadians that are retiring every day, and they all need the same thing. They need safety and they need income. And the challenge is obviously the yields. Bonds will be under pressure in the coming years as interest rates will be increasing. So what solutions, what alternatives do Canadian investors have?
That's a great question, Darius. That's the $1 million question, right? Because it's the focus on what the markets are right now. Let's kind of take a step back and look at where the bond markets are. Like you said, the interest rates are potentially going to increase because the inflation is already under pressure. Because of the hyper growth that all the economies are experiencing coming out of the pandemic. So if it's normal times, I wouldn't have said that because it's not so normal times because of the pandemic. All the pent up demand, from 2020 is kind of taking over in 2021 and potentially in 2022 and beyond. And that's why all the banks, central banks, Federal Reserve, Bank of Canada, European Central Bank, all are saying, look, what, my inflation target was maybe 2% or slightly under 2%. Now I got to change it to 2.5% to 3%, right? So if that happens, what's going to happen to interest rates? It's going to go up. Maybe it's not going to go up in 2021. Maybe it'll go up in 2022 because originally, if you roll the clock back and listen to the bankers, same time last year, they said the interest rates are not going anywhere till 2023 and 2024 potentially, right? Because it was a slow recovery. We don't know the shape of the recovery. It could be a W, it could be a V, it could be a U. I don't know. I'm not going to play with the alphabets, right? It's all about, yeah, they're going to recover. Yes, the interest rates are going to go up. So that means that the yields in the bond market are not going to be there, number one. And the equity markets are trading at an all-time high. 2020 for equity markets was so bullish. It was basically like no pandemic. If you're invested in equity markets, take the month of March out of the equation. Okay, month of March 2020. Equity markets behaved as if there was no pandemic because they were pricing in the future growth. They're pricing in the recovery in 2021 and 2022, and they're trading at 29, 30 times the valuation of the companies. So equities are pricey. Bond markets are where they are. That means that the yields in the bond markets are not going to pay you. So where is the investor going to go? Think about it. So if you look at the pension plans, let's look at the pension plans, why they have done what they have done like 10, 15 years ago. The actuarial rate of return in Canada for a pension plan to be in the money is approximately 5.25%. In the US, it's just over 7%. 5.25% in the bond market, not going to happen. Yeah, in the equity markets, you're going to get probably 4.5% or more, but it brings volatility. So that's why I think the Canadian pension plans, which are actually highly respected in the world, thought of this a long time ago and diversified away from public equities and public fixed income and went into private markets. And the private markets are fantastic because they're not correlated with public markets. So the 60-40 that you referred to, Darius, is, like I said, it's like a dodo bird. It's an extinct animal, right? It's gone away. Anybody who refers to that right now, should really, start picking up some books and reading about alternatives, because that's where the money is. That's where the income is. Like you said, 1,000 people retiring, they want income. They don't want to play necessarily in the Teslas of the world where they're making, on capital gains. They want 5, 6, 7, 8%, whatever the return that they want return, and they want consistent income because they have to pay their bills and they have to, do their groceries, right? These are not people who are multi-billionaires, where they don't have to worry about current income. So from a current income perspective and and minimal volatility perspective, private markets, I find that, because my background, for the last 15 plus years has been in private markets, I find are the best place to start investing and slowly diversifying away your portfolio from your traditional equities and fixed income.
Okay, so a very good point you made. I mean, CPP is a good example. Until 1999, their full allocation was 100% Canadian government bonds, and they changed that allocation. It's actually, if we look at the slide, it has been going from full bonds. It has been going towards 24-26% into private markets, and we can see a more diversification. Give me an example so we can understand better. Let's look at a private investment that we can use as an example.
So sure, yeah, you're exactly correct. I mean, if you go and look at it, the alternatives in a CPP or an Omer's portfolio is approximately, I would say, between 45 and 50%. And within the alternatives, the private markets probably, like you said, anywhere from 25 to 35%. And typical allocation there is for any investor in private markets, I would recommend is anywhere from 5 to 25, depending on the situation, 5 to 25% of their assets. So to give a good example, I would say I would take private debt, as one of the vehicles in private markets. We could go into other parts, but let's focus on private debt. And within private debt, basically the opportunities, is very simple. There would be a company that requires, an investment, a loan. Private debt obviously is debt. It's a loan. They either can't get what they want from a traditional bank, or their structure looks more complex that the traditional bank cannot satisfy from a risk perspective, so they're not interested to do the transaction. Or sometimes the speed of transaction. Sometimes a lot of the M&A transactions, the mergers and acquisition transactions, require sometimes a faster resolution or speed, where sometimes the banks get boggled down in bureaucracy and can't get to the finish line quicker. So they go to what you call non-bank lenders. So a company like this, let's say, needs $10 million. A traditional bank cannot satisfy that need. So they go to a non-bank lender, and the non-bank lender looks at it, and obviously it meets the criteria. They would invest in it. And the non-bank lender's money the traditional banks, remember, have balance sheets. So their money comes from your deposit, my deposit, all the other stuff. But a non-bank lender, where does he or she get the money from? So they get the money from investors who want to invest in alternatives. So they take that money and invest in this, let's say this $10 million loan. And the $10 million loan, typically, in my world, in the private debt, you want to be senior secure, meaning top of the capital structure, with a regular coupon of anywhere from 10 to 12% with other fees attached, where your internal rate of return for something like this would be around 15%. So that way the investor can get his 5, 6, 7, 8% return on his investment. That is a typical a private debt investment, where you're investing in a loan, senior secured to a company, fully backed by all the collateral of the company. I want to mention that. So it's basically you can compare it to your first mortgage on your house. If somebody says to an investor saying, "Hey, look, I have a house. It's worth $10 million. Can you give me a loan for $5 million?" So I would take the house's collateral and I would say, "Here is your $5 million," and I would have first charge on the house, first lien. So exactly, it works the same way with the companies. You take all the assets of the company and you look at the assets and you say, What is the value of the assets? The value of the assets, let's say for a $10 million loan is, let's say, 15 million. And I would say, okay, you know what, the $10 million is supported by assets worth 15 million. Here is a loan for, 10 million. And then you would have a term. Typically, terms in private debt are anywhere from, traditional private debt is anywhere from, I would say, 1 year to 4 years. Those are the typical terms. It could be less. Most of the traditional private debt structure you would look at, whether it's in the US or Canada, is averages around, I would say, 24 months.
Okay. So if I'm understanding correctly, and I just want to reiterate a couple of points that you've made. You mentioned senior and secured. So basically, the first one's in line, and secured, there's an asset. What is the typical loan to value for a loan like this?
Yeah, so that's a great point. So senior and secure, two words that everybody has to remember. There is variety of private debt out there. Just as an example, I use senior secured, but there is junior, there's mezzanine, there is subordinated. So all those structures are there, but they're all below senior secured. So senior secured, Darius, like you said, comes at the top of the capital structure. It's the first in line if something happens to the company. So you're not only senior, within the security, there's also first lien and second lien. So one thing I want to be very clear is, obviously, senior secured first lien is better than senior secured second lien. Right, so your lien on assets is number one, because there's a registration system called PPSA in Canada, where every lender has to register their collateral charge. So that's where this would go in, and then it gets registered. If something happens to the company and you get in front of the court and the judge, that registration, where you are in the registration system, and number one, number two, number three, it does matter. So that's number one. Typically, when you take assets, you take all assets of the company with an agreement called general security agreement that you sign with the lender, with the borrower and the lender signs. I would say for a senior secured first lien loan, the loan to value, ideal loan to value should be anywhere from 50 to 60% is a safe place to be. Some people would go to 70, 80% loan to value. You're getting to the edge there. I would say anywhere from 50 to 60 is a good spot to be, because that 40% gap that you have, gives you some margin of error if things do go wrong, because the valuations could go wrong, the company could, the markets could be really down, nobody wants to buy the company or liquidate the assets. So all of those things taken into consideration, you would say, anywhere from 30 to 40% gap between where the loan is and what the value of the collateral is a good number to have. It's conservative, but I'm all about capital preservation. Like I said, it's all about, when it comes to private markets and particularly private debt, you don't want to lose your capital. You don't want to put that capital to risk. If I earn maybe 50 basis points less, Darius, I'm okay with it, but I don't want to sacrifice capital. So taking that view, I would put the loan to value anywhere from 50 to 60% as a conservative number.
Got it. So let's say if I'm not used to having private investments in the portfolio, and I'm listening to you, and I'm thinking, why, is this not risky if the banks are not lending to these companies? Can you shed a bit of light on that?
Yeah, that's that is the common perception. If banks are not lending, I should say, banks are not lending to this company, why do you think that company is lendable? Right? That's what a lot of people go through, and they think it's risky. Actually, it's completely opposite. I'll tell you why. One is banks are subject to, in Canada, I'll focus on Canada. Banks are subject to what you call the banking regulation under OSFI. It's the Office of the Superintendent of Financial Institutions, right? So they're subject to that, and they have what you call a risk rating matrix, where they use risk valuations and risk methodology to account for what kind of loans are in the balance sheet, because they're subject. It's a regulated entity. Banks are regulated entity. They can't just go out and do whatever they want. It's subject to regulation. So for every risk rating that the bank has, there's a grid. There's a specific definition you have to meet, and then there's a price. That means the rate of interest, and the fees and all that you charge, right? So sometimes what happens is, if the specific borrower's numbers doesn't fit into a specific box within the bank's methodology, banks don't have a way to do it. If it doesn't fit in the box, it doesn't fit in the box. The EBITDA, for example, I'll give you earnings before interest, taxes, and depreciation, has to be X. Let's assume that the risk rating grid says that. If it's not X, what are you going to do? Where is it going to fit? So a lot of the times what happens is sometimes these companies don't fit into the bank's lending criteria, as smoothly and as cleanly, as the regulator requires. And because of that, banks say, no, I can't do the deal, because it doesn't fit into my specific definitions. That's number one. Number two would be speed to market. Like I said earlier, a lot of these transactions, are event driven. I call them event driven because there is something happening, in the business. Whether there's a management buyout, there's an impending acquisition, or there's a restructuring of the balance sheet. They need to get something done sooner than later. So banks take their time. In private markets, you can close a deal from the first call to the actually the money going out the door in less than 4 weeks. Banks typically take more than 8 weeks to go through the system because it takes time. So sometimes that's why the private equity firms, if you look at it, traditionally use non-bank lenders. Are those deals bad? Absolutely not. It's private equity firms think they want to, get the business done, right? So they say, what? Look, I'm not going to wait for the bank 8 weeks, to get it done. I want to, get the deal done, and I want to get it done fast. So they go to non-bank lenders. That's why the private equity firms or sponsors, we call them, use non-bank lenders. That's number two. Number three is structure. Structure that the banks are used to is typical structure. For example, I'll just give you an example. Because I used to be in the bank. If you grow too fast, the credit person in the bank actually gets nervous. You would think the growth is good. They say, no, that's that. If you're growing at that speed, that's too fast. If you're driving at 40, it's like driving a car, right? If you're driving at 40 miles, maybe I could buy into it. But if you're driving 60, I don't know, it's kind of risky. It's not like somebody is driving at 80 or 100 or 150 when the speed limit is 40. They're driving maybe 20 kilometers over a speed limit. But the credit folks in the banks get very nervous about that. They get nervous when the growth is not there. They get nervous when there's too much growth, right? So they can't handle those kind of transactions. So, structure, speed to market, and not able to fit into a bank box, I would say, are the three main things why borrowers come to non-bank lenders. Because they can satisfy all these, and the pricing is more or less, it's more or less I won't call it more or less the same. It's more expensive, but remember, it's cheaper than equity. Right, debt is always cheaper than equity. Why would I want to dilute my, my shares in my company and give you equity when I can borrow money and I can pay it off in 12 months or 18 months or 24 months, and then then off I go, right? So that's why you see a lot of deals coming to non-banks, and just to give you a number, it's not a million here and a million there. That non-bank business right now, mostly in North America, but this is a number from Preqin. It's almost $900 billion US in AUM, right? Which is in the works, right? It's not a small number, right? So it's a big number. It's only going to grow. The Alternative Investment Management Association projects by 2023 it will be approximately 1.2 trillion just in private debt, being placed around the world.
Right. So look, that makes sense. I think I can definitely relate, or anybody that's tried to get a mortgage that, let's say, has income not coming from a salary, let's say dividends from a company that they own that's very successful, and they don't tick a certain box. So, in terms of the rigidity of the banks, everybody experiences it at a simple thing like a mortgage, right? Correct. So I can definitely relate to that. What about the interest rate? What would be the typical interest rate on a private loan?
Yeah, so the private loans, obviously, so the private loans are kind of set up, Darius, to give investor anywhere from, if you look at the Cliffwater lending, it's an outfit out of the US. There's a benchmark called cliffwaterlendingindex.com. So anybody who's interested to look at what private debt provides as a return to investors can go on that website, cliffwaterlendingindex.com. And then it mixes up, different categories of private debt. I'm not saying that it is specific to senior secured first lien, which is what I'm talking about, top of the capital structure. Typical return on senior secured first lien debt, just like your first mortgage, which is the safest debt out there, is anywhere from, I would say, between 5 and 7%. Is what you would get as an investor. To get 5 and 7%. To the investor, remember, there's a huge infrastructure. When it comes to the lenders, that they need to have an office. They need to have an origination staff, underwriting staff, account management, all the due diligence stuff, and obviously all the financial people. So it's a huge infrastructure costs are involved. So they would have to charge the borrower anywhere to give you between 5 and 7. They would have to charge the borrower anywhere from 10 to 12%. Interest rate plus fees. There's what you call facility fees. Usually it's 1% of the loan amount. And then there's the account management fees, which is usually around 15 or 20 basis points of the loan amount, right? So all that, if you include a typical internal rate of return, typical IRR on a private debt of somebody who provides private debt to companies around 15%, where you would get potentially between 6 and 7% to the investors. So the other piece goes to carrying the GP's infrastructure, like I told you, the account management, underwriting, audit, origination, office, and all that overhead that the GP has. Because you do need a lot of infrastructure to do it. Because investing in private debt, one thing there is it's complex. The loan documents are like over 150 pages long, so it's very detailed. It needs expertise. Somebody who doesn't, who has never invested in private debt cannot just go tomorrow and say, yeah, I'm going to start lending money out to people, right? You can potentially do that on a house. I know a lot of my friends who do that, as provide second mortgage or first mortgage on a house because, it's simple. But when it comes to lending to companies, it's very complex. So the infrastructure that you require is pretty intense. And also the fact that the expertise is needed, to lend money. And remember, lending money is just is the easiest part. It's getting the money back. It's all about getting the money back. So you have to have the infrastructure. That's why you see the difference between, you say, oh, Ramesh, you're saying 15% IRR, and I'm only getting 7%. Where did the other 8% go? Obviously, there's a lot of expenses with the fund, and then the fact that somebody has to hire all these people, and they're not cheap. To set up a private debt shop, a private debt or private equity. In this case, let's say private debt, it's expensive to set that up. That's why you see that delta.
Got it. So tell me, let's say I was invested in private debts last year, February and March. What would have happened to my portfolio?
Well, so that's a great question. So it all depends on who you invest with. If you had invested with a credible party, I'm not going to say any names here. But if you're invested with somebody who has done this before, that's why we always say, in my view, invest with somebody who has gone through a down cycle in the past. Whether the 2008-10 the GFC, the Great Financial Crisis, or the early 2000 late 90s tech bubble. Make sure that they have gone through a couple of downturns, because then that they can manage well. Let's assume, Darius, you're a smart guy, you did your research, and you invested with somebody who has done all that, has the experience, has the track record, of going through these downturns. You would have come out fine. You would have seen your portfolio statement in February and March, and you said, Ramesh, what happened here? My private debt is down, 5 percentage points. So I said, Darius, calm down. It's an accounting entry, because I'll tell you why. A lot of the private debt took an accounting entry to market their portfolios, because private debt, remember, doesn't do it's not an automatic mark to market because there's no public market. So any good private debt lender would do that. So that's why I always say, if you had picked one of the top private debt lenders out there, you would have seen a mark to market on your portfolio statement, where you would have seen, let's say, a 5% drop in your net asset value on your portfolio statement in March, and you would have called me and said, Ramesh, what is this all about? And I would have said, look, Darius, calm down, because it's nothing to do with credit quality. That means the borrower itself is safe, but the accounting rules, in Canada, which is the IFRS 9, and in the US is US GAAP, GAAP, dictate that I carry all my loan on my portfolio at fair market value. So that means, you cannot carry it at cost. You have to carry it at fair market value. How are you going to determine fair market value for a private loan? The fair market value is calculated on a discounted cash flow methodology using discount rates. And obviously the discount rates depends on what the spreads are in the public markets, right? So they would take the spreads in the public market where the spreads really widened in March. So then obviously you had to reprice it. So a lot of them were marked to market, where the loan, which was, let's say, $10 million in cost, had to be marked down to $8 million based on the spreads at that time. Is the credit bad? Am I going to lose money? Absolutely not. So if you had done that, you would have seen that in the March. Then from March on, it's only going like this throughout. So, right across all the private debt structures that I know of, particularly with ones with a lot of experience and track record, they have done extremely well. So they haven't lost money. So you wouldn't have, in your case, if you had done all the things that I told you before, you would have lost no principal. You would have probably made 6, 7, 8% return on your investment, and your portfolio quality would be equal or better than it was in 2019 December. So all boxes ticked if you're done well, because private debt, they had no, even though there was some mark to market in March, that was it. And that was, like I told you, that's purely an accounting process. It has nothing to do with credit quality. So you would have done well.
Got it. So to recap and wrap it up, private debt has a place in the portfolio. I mean, OMERS, Ontario Teachers Plan, CPP, everybody does it. So anybody that has a regular pension is already invested into private debt. We have senior and secured, so with high collateral, much higher than we can see on mortgage investment companies and other products that are out there. The return is way above anybody can expect from a fixed income product. And what about tax efficiency? A lot of the clients, sorry to cut you off. A lot of the clients have a focus on this. When you have, let's say, money in a holding corporation, when you have money in a non-registered, you have to think about the taxes as well.
Yeah, no, it's absolutely. I mean, it's all about after tax, right? I mean, everybody should focus on after tax return, because, before taxes, what does it matter, right? The government takes away so much. So one thing that I do want, before I go into that, is, I want to add is, all those points you mentioned, Darius, highly valid. One thing is also non-correlation. Remember, private debt is not correlated to public markets, in private equity, whether it's equity, public equity or public fixed income. That's another advantage of having something that is uncorrelated in your portfolio, because it's less volatile or not volatile at all, and that reduces the volatility of the entire portfolio by adding private debt to your portfolio. That's number one. So once we gone that, let's look at tax. So obviously, private debt, if you're looking at current income, let me take a step back before. So who can invest in private debt? Typically, people who can invest in private debt are what you call accredited investors, because it's an offering memorandum product. It's not a prospectus product. Anybody who's an accredited investor is usually not only knowledgeable, but they also have sufficient net worth or sufficient income that qualifies them to be an accredited investor. So that way they know what they're getting into. That is the Ontario Securities Commission regulation, and it's nothing to do with the risk, right? It's not necessarily risky, because the OSC, just because OSC or the regulator is not fully comprehend the risk, they'll say, okay, you know what, you got to sign all these papers, because you might lose your money. So the accredited investor is somebody who is fairly well off, and then and can invest in it. And most of the private debt products out there, at least some of them in Canada, are all tax eligible for RRSP, RRIF, RESP. So all those tax plans, they're eligible, because if the notice period is anywhere less than 6 months or less, usually it's eligible for the tax plans. So that's number one. So you can benefit from investing through your RSP or RESP, RIF, whatever that applies to you, TFSA, if you have one. So you can use all those tools to make sure that you reduce your taxable income. That's number one. Number two is, From a purely tax perspective, obviously, I'm not a tax expert, and I'm not going to say that, take my advice. You should always consult your tax advisor for the best possible advice. But my view is that depending on the type of private debt, because like I said, there's lots of private debt. If you're focused on a private debt that is senior, secure, first lien, focusing on current income, is usually anything that comes out of it, the distribution that comes out of a strategy like that one is considered income on your from your tax perspective. So that means that you have to pay. It's not considered as dividend. It's not considered as capital gain. It's considered as income, and you pay whatever tax is applicable to you as income. But if you're investing in a private debt where the focus is on more at the tail end of the term of the investment, the private debt investment, most of those returns are considered as capital gain, because what you're doing is you're investing in a private debt opportunity, call it a distressed private debt, right? Because there's a lot of vehicles which offer distressed private debt where there's a lot of turnaround plans. So you invest your 10 million or whatever money you have. And then, at the end of third or fourth or fifth year, you would get back, let's say, 15 million. So that 5 million, most of that is considered capital gain. So obviously you'll be taxed at the rate that capital gain gets taxed at. So depending on it, if you're more, if you're a retiree and, you want income and the private debt vehicle is distributing, let's say, 5, 6, 7%, of annualized income, then you will be taxed, from an income perspective. But if it's a longer term investment where you're not getting the distribution annually, but you're getting everything at the tail end of your investment, it's more of a capital gain plan. But obviously, the tax advisor who knows you well and who knows the investor well is probably the best place to get the advice from. But there is a different ways of minimizing taxes. I mean, and I wouldn't call it private debt is any different. But because it's an offering memorandum product, I would say investors, make sure that you read, everything that is in the, obviously in the documents, and consult your tax advisor before you invest.
Thank you, Ramesh. I hope everybody found it as valuable as I did. Thank you very much for joining us today.
Thank you, Darius, for the opportunity. We look forward to having you more.
Thank you.